Hey, how's it going, everybody? We are officially live on all of our platforms, so welcome. We have a very special guest today on Charitable Secrets. We have Tiffany House. How are you doing, Tiffany?
I'm wonderful. Thank you so much, Michael, for having me.
Absolutely. Absolutely. So we are going to be talking a little bit today about some proposed tax plan that the new administration has for us. And so we'll talk a little bit about that and also a couple of strategies that we can think about that we need to be taking as far as tax planning, estate planning, and things like that. So Tiffany, go ahead and tell us a little bit about yourself.
Well, my name is Tiffany House, and I call myself a recovering financial advisor. I was part of the family business of financial advisory for almost 20 years, and I never really wanted to go down that path. I have always had my focus on charity. So I love charitable trusts, charitable Mater Trust, charitable lead trust. They were an important part of our practice that were helping high net worth individuals across 16 different states do proper planning to be able to come out with the best tax advantage outcomes for themselves, as well as helping the community. So I started focusing more on the charitable component of it and decided to become an expert in charitable planning as well as business exit planning strategies. So now I do consulting for gift planning, and for those who are exiting their businesses, I can help walk them through their planning process and help them find tax advantage sales solutions to increase the amount that they would get from the sale of their business. So I'm so happy to be here. I not only am a passionate about charitable planning, but I also do it myself. So I have 3 children, and I got remarried a little over 3 years ago. And when we went to go do our Thank you. A wonderful man who's also a financial advisor. I can't get away from financial advisors, apparently. Um, so I have 3 children that I brought to the marriage, and it was not even a question. When it came time to write our estate plan, we knew that we wanted 10% going to nonprofits. We were a
Yes.
little concerned, how are the kids going to think about that? So we sat them down and we said, you're getting 30% instead of 33%. And it was a fabulous conversation. They totally understand it and support us in that.
Good. How old are your kids?
We have 18, 16, and 13.
Oh,
All
nice.
girls, lots of teenagehood going on here.
Awesome. That's great. So I think I definitely commend you for that. Having your kids get involved with the charities and stuff like that. We were talking a little bit beforehand about some of the charities that you support, and I definitely think that's amazing. I definitely think it should be a part of everyone's estate plan is to involve families and talk about money, talk about wealth, talk about giving back to the community. I think that's absolutely important. So definitely awesome job.
Well, it is so important because we have to teach our children about money and what it actually looks like, also about community and civic engagement. So we did also this year, our goal was, and we did actually accomplish it, to create a donor advised fund. And we let our kids make donations to nonprofits. They get to pick the organization, do the research, and they get to grant from that twice a year. So we're really excited about that. So they're going through their first round of picking their charities right now, and it's really fun to be engaged with them in that process.
Amazing.
And really see what's important to them, right? You get to find out new things about your kids.
Yeah. So do they have to do any kind of formal presentation, or do they just come to you with a, hey, I want to support this charity and this is why kind of thing?
So far, it is the latter, but I think that would be a great process to include in the future, to be able to have them go through a formal process. So something definitely to look forward to. And I know, Michael, you have similar planning with your family. Do you have a form or something you can share with me that would help?
Well, so my kids are a lot younger.
Okay.
So my oldest is 9, and then 8, and then 6 here in a few months, and then 1. And so they're not totally involved, but we do talk to them about the charities that we support, the goals that we have. When they turn 12, though, is when we plan on having them do the formal family council and proposing to different charities that they might support. And so that right now they're kind of in a junior advisory role where they just kind of watch what we do. But then when they turn 12, by then, hopefully they'll be ready to actually understand what they're proposing. And then what they don't know is that when they propose what charity to give to, they're going to be involved with that charity for about a year. And then hopefully they'll be able to see the impact that money has on that charity. What kind of, do they hold the charity accountable to making sure that they're doing what they said they were going to do, which most of them, I think do. But then after another year comes around and they come back and report, what did they see? And then if we should give again to that charity, or should we find one with a similar mission, something that's important to the children. So yeah, it's very similar. I think every family does it differently. And I think that's great. I don't think there's one way to do it. And so whatever is important to the family, however they want to structure that, is awesome.
Yeah, it makes it fun. It adds for another level of engagement and family conversations as well, too.
Absolutely. Absolutely. Yeah. So as we were talking a little bit before, though, is teaching kids about wealth, teaching them about how to handle, the transfer of wealth even is important as well. And I think that's important to talk about with our topic today on the proposed tax stuff that's going to be coming through. And so I think you have some great insights on that, though.
Awesome. Thank you. And yes, I do have a very long presentation, but I'm not going to bore this audience with all of it. But we thought maybe today we could hit some of the highlights of some of the slides that I think are really important. So happy to walk through that.
Awesome. So let's go ahead. You want me to pull it up here real quick?
Great. That'd be wonderful.
Yeah. Okay.
All right. And just one more thing about me. I am a chartered advisor in philanthropy as well as a certified exit planning advisor. I was fully licensed for financial advisory, but I decided to let all of that go so that I can work with donors, their advisors, nonprofits, and families to really help them make good decisions and do proper planning without any, and in a fiduciary capacity, without any bias by what I might actually have to add to it.
Awesome.
So I've got to just.
What does that mean, though, real quick? When you say like an exit like you're talking about exit strategies. So like, what can you explain a little bit what that is?
Well, when most people go to sell their business, they often don't think of what their take home is actually going to be from the sale of their business. A lot of the medium-sized businesses end up being more of a lifestyle business. So I help people walk through looking at where their situation is now, what it is that they want in retirement. Are they going to slow down? Are they going to find it? Are they going to try and buy another business? Or a lot of 75% of business sales don't happen because the business owner gets scared because they've been so used to being the CEO, director, making everything happen. Their identity gets a little wrapped up in that. So helping them through that process. If they need value acceleration within their business to make it most profitable, we also help with that. And then tax advantage planning tools, whether they're charitable, like a great charitable remainder trust, which we're going to discuss today, or if it's looking at other opportunities like opportunity zones or deferred sales trust or changing it into an ESOP. We can employee-owned stock program. We can take a look at what all of those might benefit the seller and help them through the process to be able to get what they want out of their hardest earned asset that they've put so much into.
Absolutely. Awesome. Thank you for explaining that. I appreciate that.
Yeah, you bet. Well, and I like to really think about right now we're kind of in a perfect storm. And when I first saw this slide, I thought, some people might think this is like COVID because, everything's been crazy. There's so much going on. Some people might think taxes, oh my gosh, it's overwhelming. But I really see gift planning and making good estate planning choices is really the light at the end of the tunnel for us all. So you can view this presentation in more detail. I have given it, and it's live on my website if you would like. And there's a lot of different proposals, but one thing I wanted to just remind people is that above the line charitable deduction that we had in 2020 was also included into 2021. So regardless if you itemize or not, now $300 per individual or $600 per couple can now get a federal income tax deduction. So I just wanted to make people aware of that.
Awesome.
And I am a little concerned because we're in a changing landscape right now. I borrowed some materials from Market Smart. They do a great presentation on the changing landscape. But there's some curious markers out there that are changing. And this is my kind of rendition of their hour-long presentation in one slide. So, but one of the things that they pointed to and had research on, religious giving has decreased. And it's been a continual steady decline. So
this isn't just recent, it's been declining over a while.
Yeah, it has, unfortunately. And one of the big concerns for nonprofits is usually if somebody gives to their church or to their religious organization, they're going to give to other causes too. So if we have people doing less religious gifting, does that mean that they're going to do less gifting overall? And also they had studies that show that people trust large corporations more than nonprofit organizations. And that one just kind of scares me. So when I talk to nonprofits, I say it's all about trust. Get your donors to trust you and the impact that you're out to create.
Yes.
Yeah.
I think a lot of times now you see, like Starbucks and these other big corporations, they have these impact programs or these social programs where people, I think, want to see their dollar stretch a little further. And so when they shop at Amazon, they use Amazon Smile, for example. And so they know that their purchase, even though they're getting something, it benefits charity or it benefits the community in some way. And so I often kind of giggle a little bit every time I'm at the grocery store and they want my 30 cents, to round up to charity. And I'm like, oh, wow, 30 cents, but I guess that can add up a little bit. So do you feel like maybe more people are giving that way and that's why they're not giving to whether it's a religious organization or a nonprofit?
I think that could be part of it. I also think that we're talking about socialistic beliefs now in our country way more than in my history of 44 years of being here. And I think that when people are looking at socialism or a more of a trend towards that way, they think that the government or others should be taking care of the people who are more underserved in the community. And that was an interesting, it took me a second to really understand that, but I now kind of get it because in my opinion, I was thinking that they would be more giving, but they think others are handling that. I also think we have a generational shift. We have, we've seen some huge differences, and my kids all being teenagers, I know the difficulty of screen time. And it's just a different mentality, and it's a much more immediate gratification that I see. And I don't know, maybe I'm sure as a teenager, I had a ton of immediate gratification going on as well too. But the one thing market
not like today. I mean, we've been watching the Winter Soldier series on HBO Max, and my kids are upset that they have to wait a week for the next episode. I'm like, you guys have no idea what the struggle was. Wait till the series finale or like the season finale. You have to wait months, And so anyways, I thought that was interesting.
I think is very interesting. And Market Smart also in their presentation had two graphs up. One that showed the amount of people or the number of people giving and what the Starbucks spending is. And Starbucks spending is soaring and the number of people gifting is going down. And I think that people are choosing, hey, do I want to give my $5, $10 monthly commitment to K-Bot, K-Jazz or something like that? Or is that's my Starbucks for the week? Maybe I'm going to choose Starbucks over that,
Wow.
which concerns me.
Yeah. Yeah.
Yeah.
That's interesting. That's interesting.
And studies are also showing that fewer people are giving, but the average gift size is increasing.
So what does that mean?
So we are having less people be charitable, but those who are charitable are being more generous.
Mm.
So what does that mean? That's a great question. I really like to see the numbers of people giving as we engage the next generations to come increase. And I think if the gift size is actually getting larger, it's probably because they're utilizing tax advantage strategies to be able to create win-win scenarios, which is fabulous.
Yeah.
But I've got to tell you, I've talked clients into when I was a financial advisor, I've talked clients into charitable remainder trusts that weren't charitably inclined when we first sat down. But when they saw the benefit that they were able to save their tax money and keep it working for them and take income from it, it was an easy decision for them after I showed them the numbers.
Yeah, we've experienced the same because we do CRTs or charitable remainder trusts as well, and it's interesting to see when people, first off, a lot of people think that they just give cash, when in reality, people are donating real estate, they're donating business interests, like what you were saying earlier, when they exit out, of their business. And so I think that's also a little bit as people maybe starting to gain a bigger understanding of what they can actually donate. But we've also seen it where when they do that, suddenly something sparks within them and they're no longer really doing it they may have started with a tax advantage, but now they're starting to think, hey, I'd like the idea of being a philanthropist. I like this ooey gooey feeling that I'm getting, when I'm giving to charity and having some kind of role in that charitable endeavor. And so they start to actually give more. Sometimes when they get that income from the CRT, they actually donate it again, to a donor advised fund or to a charity or something like that, because maybe they don't need the income or whatever, but they get another tax deduction and it makes them feel good. And there's, it starts a domino effect, really.
Yeah, definitely. I have seen the same, and there's research out there by Dr. Russell James of Texas Tech
I love
University.
that guy.
Oh, you know what? This is one of my only presentations without some of his slides in it because I always use his stuff.
Yeah.
But he talks more scientifically about that ooey gooey feeling, and it says it's oxytocin. And what I love when I have planned giving conversations with people, I try to get their oxytocin going. And oxytocin's released when you share stories about yourself. And I love that because I'm a proponent for more financial advisors, attorneys, CPAs to have these conversations with their clients and learn what's important to them. And when they go into conversations about charity, usually the client's going to open up with some stories about themselves. And then you get this oxytocin, which is a connection hormone that allows you to connect more to those people. And so you're building a deeper relationship with your client, and it's wonderful. And they're engaged and excited as well too, because they get oxytocin going on. And then when you give gifts, you get the oxytocin rush too. So
awesome. Yeah, giving is a drug. It's awesome.
Yeah. Yeah, I used to say get a love rush from get a love rush from death and taxes.
I like that. I like that.
Yeah. Well, to kind of go into some of the Biden-Harris tax plan highlights, I chose a few. There are others in the beginning of my presentation. There's more at the end that I don't even talk about, but they're there for reference. But there's some things coming up certainly with, and I'm going to start with estate tax planning because I think this is a great place to start if you don't mind.
Absolutely.
But The proposal is that the estate tax exemption, so what the exemption is if your estate is under the exemption, it can pass tax-free to heirs. Anything that's above the exemption gets taxed at 40%, which is which Biden is proposing to increase that to 45%.
Wow.
So the exemption currently is actually at 11.7 million in 2021, but I have 11.58, which was 2020's numbers in this presentation, because we think it's going to change this year. So we don't really know what it's going to be, or at least that's my crystal ball. And the proposal is to change it down to $3.5 million.
Wow. Wow.
So that means right now, people who are making, 23 million, or who have $23 million or more, have been concerned about estate taxes. But those who had less than that weren't concerned. And I know back in the day when it was $1 million, and it was 2, 3, 5 for a while, and it's been kind of changing. We did a lot of life insurance planning so that people wouldn't have to sell sell part of their assets right at death to pay that estate tax liability, because when it's 45%, that's half of what you have. So if you're married and you have an estate over $7 million, you need to go visit your estate planning attorney and really do some work and preparation for this. And the community is all in line that this is something that's going to happen. It could happen in 2021. It's very likely to happen in 2022, because the 11.58 million, the large estate tax exemption, was due to go down to 5 million, sunset down to the 5 million in 2025. So this is something that tax planners have already kind of had on their radar. So it's something that we see that could happen.
Mm. Mm.
And the other proposal that scares me is the elimination of step-up and basis at death.
Yeah.
So with the step-up at basis, let's say that my father had a $500,000 investment account that he had held his whole life, and he paid $100,000 for it. Now it's at $500,000. If he passed away today, he could pass that on to me tax-free. In the future, with the elimination of step-up and basis, I would be liable for $400,000 of capital gains when I receive that asset. And if we're talking above the estate tax exemption, I might have to pay estate taxes on it as well, too. So the reason this one kind of scares me is because I think the true winners are going to be the people who do estate administration and accounting, because it's going to be so hard to find out what my 100-year-old grandma paid for something back in the 1940s. So I see it as costly and time consuming.
Yeah, it makes it more difficult for one generation to pass their wealth on to the next generation. And so it doesn't really, in my opinion, it doesn't really help people step up, and I think that's why it's called a step up in basis. But it doesn't really help them get out of the current situation. It actually might maybe hurt them, because now they're having to pay all this tax on something that they just inherited. They really didn't buy into it or anything like that. So the option would be to probably just sell it and then pay most of the tax with the money that you get. So that would be concerning.
It is concerning. And at first I thought, there's no way this is going to happen. It only ever happened once in the tax code in the past, and it only lasted a year because it added too much complexity. But what I've heard in the community that plans for this kind of thing is that it's easy. Like, if Biden and Harris do that, most people aren't going to even know it unless they are receiving assets from somebody who died. So versus raising everybody's income tax and capital and all that kind of stuff, it's a sneaky tax to kind of throw in there that isn't going to affect many people. So the skeptics were saying like there's a 15% chance. Now they're saying up to 50 to 60% chance that that might actually happen. We'll
Wow.
see. That's just kind of our opinions on it.
Yeah.
But I think it's important to realize that it could happen and that we might need to do some planning around it.
Yeah. Something to kind of keep an eye on and have a plan B just in case something like that happens.
Yes, definitely. Well, and I like to always look at the opportunities because there's a lot of opportunities with the proposed tax code. I think that this could easily increase lifetime giving. If you can't hold on, if you have to hold on to an asset, or if you're going to have to pay taxes on it at death anyway because the step up in basis is gone, you might as well start gifting it in life. So you can gift portions of it in life and not have to pay those taxes on it. So I think donor advised funds will become even more popular than they already are. Certainly bequests, and a charitable lead trust handles the estate tax issue beautifully. So we're going to just take our next slide and look at a charitable lead trust. Just to kind of see what it does. And it was made famous by Jackie Onassis Kennedy, and it helps them mitigate estate taxes.
Awesome.
Oh, clicking on the wrong screen. Sorry about that. So what a charitable lead trust allows you to do is we'll take an asset, which is we'll call an apple tree, and we'll call the apple's income. So we take this asset, we utilize a charitable lead trust to transfer it to the next generation. We can even do it to ourselves in good planning scenarios. And we can do that completely estate tax free if we give the apples to charity along the way. So for any families who are already charitable and who have over $7 million or think they will by the time that they're no longer with us, what a great planning tool to implement to be able to pass on assets estate tax free, especially if you're already giving to charity.
Yeah.
So how this works is you're able to, so we're going to take in this example, $10 million. And we'll take that $10 million, and I like to call it like a wrapper. We actually put the wrapper of the lead trust around the asset. So the donor can maintain control of how it's invested. They are really just kind of sheltering this asset for a while, which is good for asset protection purposes as well, too.
Mm-hmm.
And we're going to take income. In this scenario, we're taking 6% income and giving that to charity annually. And with that, we're able to transfer the whole 10 million plus or minus any growth that might happen over that time completely estate tax free. So we give our 6% for 18 years. Now, the 18 years is important because right now interest rates are very low. So there's 0.8% AFR rates. And that dictates how many years that this is that you need to have it pass completely estate tax free. You could do it for a shorter number of years, but then you wouldn't get the full estate tax exemption or savings as well. So then we would take this, that would save us $4 million today. But if Biden and Harris increase it to 45%, that would be $4.5 million in estate taxes that we're able to save by putting a wrapper around the asset and giving the income to charity over time. The nice thing is too, is you can, as long as you can utilize this and put it into a family dynasty trust and really be able to manage. I like managing from beyond the grave in that you can have trust planning put forth for grandchildren or children that in situations that you might not know about when you set up this kind of trust. Oh, sorry about that. But that you can kind of control from beyond the grave through some good estate tax planning, or through some good estate trust planning, I should say.
Yes.
Yeah. Anything else that you would like to say, Michael, about charitable lead trusts? I have other slides on what it is that they accomplish, but I think they're a really beautiful tool for people who are concerned about estate taxes and want to do some planning for their kids.
Yeah, I definitely think it's very interesting. I've never personally worked with a charitable lead trust. I know it's kind of the flip side of a charitable remainder trust, where
Mhm.
in a charitable remainder trust, the donor, the original donor, is getting the income off of the investment, whereas a charitable lead trust, that income is actually going to the charity. But I definitely think your idea of having that in the wrapper, I think that's definitely very, very cool. And working with a dynasty trust and all that kind of stuff, it's definitely a part of the piece, or it's definitely a piece of the puzzle, that I think, talking to an estate planning attorney, I think that's definitely something to ask about if they're gonna get their estate planning done.
Yes, definitely. Well, and a real life example is there was a family who had a lot of farmland in Texas that ended up having one of the tollways go right through it.
Oh wow.
And it was prime real estate for the auto market. So all the dealerships wanted to come in and buy this land. And so obviously it extremely soared in value. And we went ahead and put that into an LLC and discounted it, and then put a portion of it into the lead trust to be able to transfer on part of it to the next generation estate tax free. And one thing to mention about these two, you can do them like Jackie Onassis did at death. And her kids ended up unraveling it. That was a long time ago, though. They write them better now.
Yeah.
But you can do it at death. You can put it in your estate plans to have that happen then. And then your kids just have to wait some time to be able to access those funds, but not pay any taxes on them. Or you can do it now in life. And right now is a great time with our low interest rates.
Yeah. Yeah, absolutely.
Yeah, wonderful. Well, then let's move on to income taxes. If you can't tell, I'm a tax geek. I love it. And with my consulting, I like it because when I meet families who have complicated scenarios, I can give advice on a multitude of different areas, not just one area of practice or specialty. That's the nice thing about not having any skin in the game as far as trying to sell something. I just do consulting work. So with income taxes, they are looking at having a limitation on the amount you can itemize over $400,000. Now, without getting into too much detail and what all of this looks like, pretty much if you make over $400,000 a year, we don't know if it's single or married, that you're the one who Biden and Harris are going after. They are increasing people over $400,000 of income. That's the demographic that they're going after to really increase the taxes on. So know that your limitation of your itemized deductions could be affected, but also the marginal tax rate would go is looking to go up 37% to 36%. And it's a 2.6% increase. My crystal ball is yes, that is going to happen because it came down in 2017 from 39.6 down to 37. So I see that's something that Biden and Harris can easily accomplish in their tax planning or in their tax plan.
Yeah.
Yeah, so it's nice to know some opportunities with this. You might want to bunch your gifts now before things happen. Using a donor advised fund is a great way to bunch gifting, where you can give now to a donor advised fund and then have it go out as you choose over time. Your own charitable savings account is what I like to call it.
Yeah.
And
And they can give now, and they can have that deduction roll over for, I think it's the year that they donate, and then 5 years after. Is that right?
Yes, it is. They can stretch out their deductions for up to 6 years using charitable planning tools. Exactly.
Yeah.
And another, for nonprofits out there, the qualified charitable distribution from an IRA. So anybody who's over 70 and a half can give from their IRA, that's going to be a really valuable tool. And it's really going to help any and all people who are paying income taxes. And then again, a charitable remainder trust, charitable lead trust could be solutions as well. And the reason I have so many opportunities and solutions is because it depends on your unique situation, on what tools might be good for you and apply to what you have going on. Oh, my mouse is jumping around today, so I apologize for that.
Oh, you're good.
There we go, back to income taxes. So just real quickly, what a qualified charitable distribution looks like. You can give from your IRA and not have to pay the taxes on it. And it really helps people save when it comes to Medicare taxes and taxes on your Social Security benefits. And you can give up to $100,000 per year. Here's just a quick little example of somebody who gave from their IRA, was able to give 30% more to charity while having 5% more in their pocket, and they lowered their taxable income, which allowed them to do some good tax bracket planning.
Wow, that's awesome.
Yeah, it's a great strategy. It's an easy way to give. The only one thing you have to watch out for is be over 70. You have to be 70 and a half, and the money has to go straight to charity. It can't touch the donor's hands. Yeah. So anything that you wanted to talk about a qualified charitable distribution from an IRA or anything?
So is this similar to like an IRA rollover, like a charitable IRA rollover? Is that what that is? And so something that we've done is a lot of times, because IRAs are taxed very high, and so donating it to charity, and then buying a life insurance policy so you don't disinherit beneficiaries is a great strategy, so that you can. It's a great tax advantage because you give the high tax thing to charity, you get the tax deduction, but then also upon your death, beneficiaries would get the life insurance also. And so it's a great strategy to use.
It is a great strategy, and you reminded me something that I walked over. Regardless of the estate tax exemption, IRA assets are taxed to the next generation. They're called income in respect to decedent assets. So I like to say it as the IRS is going to get theirs somehow. So if you put money in before paying taxes on it, as you do for your qualified IRA accounts or 401ks, they want to get the taxes on it at least at the end, right? So they're not going to let you pass that on tax-free to the next generation. They will get taxed on it. So if you have $500,000 in your IRA and you have $500,000 in your investment account outside of a qualified account, you want to give the investment account to your kids and give your IRA that's taxable to you and to them to charity. So it's a first asset that I always look to give, especially if they're close to 70 years old, because we can always plan for it in the future as well.
Yeah, absolutely.
Yeah. Well, next we'll kind of hop into capital gains taxes. And this I see as a big,
this is my favorite part of your presentation, by the way.
What was that? Oh,
this is my favorite part of your presentation, by the way. This thing is
well, I think that for business owners, if you want to sell, do it in 2021. Because if we can, the new taxes in the future, I think will be more difficult. And I think we're going to see the people wanting to sell their business for the next few years. That market's probably going to start drying up. I think we're going to see a lot of business sales, a lot of large asset sales in 2021. At least I think that's what people should do. So the proposal is that the capital gains tax rate on assets or income over $1 million would bump up from 20% to a 39.6%. That's ordinary income tax rates. Now, the reason that we have capital gains taxes is because the government wants people to invest into things, into stock, into land, and put money in there to grow our economy, and they tax it less than income. And people politically have different views and ideas about that. But they're really kind of making it, okay, if it's over $1 million, you're going to be taxed just the same as if you made all of that money outright. So I'm a little concerned about this. I'm hoping that it doesn't actually happen, but it could double what people have to pay for taxes. And I'll go into some tax slides here of there's additional taxes like depreciation recapture and net investment income tax of 3.8%. And then what about state taxes? You know, in Arizona, we're pretty cool here at like 4.55%. Yeah, so I think there's some good opportunities for planning there. And again, the elimination of stepped up in basis would affect if you have to pay capital gains tax at death on assets. We need to do some planning and look at maybe some gifting strategies or some other tax advantage strategies to eliminate double taxation, especially with estate taxes and capital gains taxes.
Wow. Wow, double taxation. That's always a fun word.
Yes, definitely. Well, and there's a lot of opportunities here within within the tools that we can utilize. We're going to walk through a charitable remainder trust and a hybrid or a bargain sale as well too. And I'm trying to remember if I stepped over the slides. I did do a little bit of research on, you know, how likely are these actual plans going to happen? And over the last 25 years, there has only been retroactive tax plans that have come about that help the taxpayer, not the federal government. So I think some of these, I think we could see the potential for estate taxes. I think we could see income taxes. I think we're safe this year for this capital gains tax because people haven't been given the time to plan around it. And that hasn't happened in 25-year history of tax changes that went retroactive in the year that they were instated. And Biden is much more focused on his on other agendas of COVID and infrastructure. So I'm guessing 2021, we're okay to keep that 20% capital gains tax rate. So if you have something to sell, I would say sell it now. Because when we look at 2020 capital gains tax rates, which I think will be 2021, we have an adjusted gross, if you have an adjusted gross income of over $470,000 or $469,000, this is the taxation that you can pretty much count on. So we have the 20% federal long-term capital gains, 3.8% Medicare, or I'm sorry, I call it Medicare. It's net investment income. It's to cover the Medicare tax and implemented a little while back. That sneaks up on a lot of people because it's a newer tax. We have 4.5% Arizona state tax, which makes our actual long-term capital gains tax rate to be 28.3. But then you also have to look at, what if you had depreciation recapture? Anything that you depreciated, you have to pay up to 25% in recapture. It goes up to and caps at 25%. So you could be paying 25% on depreciation recapture. And then there's that lovely, for those of us in Arizona, the Prop 208 that increased Arizona's tax by 3.5%. If that's in the inner works right now, and is not, it's in legislation because they said that we're not sure that that's actually being implemented. Some people are fighting it and fighting it pretty hard. We'll see if that happens.
Like the courts and stuff like that to see if it's going to go through.
Yeah, definitely. Yeah. So we'll see on that. But if it does go through, it's 32.8% of taxes that you would have to pay on the sale of a business or property or other assets. And I'm going to say it's actually 2022 rather than my slide says 2021 here, because I don't see us actually being able to do it retroactive. We've gone through enough time in 21 already where I think this will happen next year or could happen. This is what our future could be. So if your adjusted gross income is over $1 million, you could be taxed at 39.6%. Then we throw in the same 3.8 net investment income, 4.5% Arizona State. That's at 47.9. And then let's throw in the potential of Prop 208. That's over 50%. 51.4% could be the taxation on an asset. So you work hard for your business. You have very little cost basis in it. You might have to pay half of what you sell it for is in taxes.
Wow. Insane. 50.
Yeah, well, and so I think it's important for people to start planning. What is it that they want? How do they want to accomplish it? So we can do some good planning around it. So let's get into a tool that can really help.
Yeah.
So Charitable Remainder Trusts is a tool that helps with capital gains taxes, but it also helps with income taxes. It helps with the net investment income tax, the state tax, depreciation recapture, and estate taxes. And it's been in the tax code since 1969, same as a lead trust that we looked at earlier. And have you ever watched Mad Money by Jim Cramer?
I have not.
You have not? Oh, he kind of yells at you a lot. I haven't watched it recently. I used to watch it years ago, but apparently he's still on TV because I saw it the other day.
I'll have to look him up.
Yeah. Well, when he has a disclaimer about investments that he owns, he says that his charitable remainder trust, the Cramer Charitable Remainder Trust, it owns those stocks. So he has all of his stock portfolio inside of a remainder trust.
Interesting.
Yeah, it's kind of nice to know that people are actually using it out there that we know of, right?
Yeah, that is cool.
Yeah. I am going to see if I can. I love it when I can do this one. I think I might do it as a slideshow from the current slide. And can you let me swap my screen just because I have so much animation. Can you see that okay?
Yeah, I see that. Great.
Okay. So we're going to look at a sale of a $2 million business, and we're going with business because we're saying it has zero basis, that it's all blood, sweat, equity in this. So we have a $2 million business. Let's go ahead and kind of separate it in half. When I do a charitable remainder trust, most often I will only use part of the assets. So we don't have to use the entire business. We can use a portion of it. Well, we can use a quarter. This time we're using a half. So we'll have half as an outright sale, and then we'll put half inside of a charitable remainder trust. And because we do that, we'll allocate that interest, put it inside of a trust, and we pay zero taxes when we sell it.
I like that.
What was that?
I like that. That's nice.
Yeah, right? Keep the whole $1 million working for you and get income. But that saves us $288,000 in capital gains tax savings. So we just saved $288,000. We have $1 million in this charitable remainder trust. And at second, we're going to go ahead and choose to leave it to a charity, or it could be our own donor advised fund, and we can use it to teach philanthropy to our children, like Michael and I were discussing earlier.
Yep.
Because we're giving it in the future to charity, we get an income tax deduction today. These people, 265-year-olds, qualified for a $275,000 income tax deduction, and they're able to take income for life. So we chose 6% in this scenario, that they're able to get 6% for life. That starts off at $60,000, and that gives them, over their 30-year life expectancy, about $2 million of income from that asset. And because with this scenario, we didn't want to forget the kids. Like Michael said, insurance is a great way to go about making sure that the kids are not excluded. We bought some life insurance for $1 million, and that way we are able to give the kids something. So we took their $2 million lifetime income, paid $300,000 of premiums, so they have $1.7 million of lifetime income. They have the $1 million going to their kids. They have the 1.3 million, the residual going to their charity. And this income tax deduction here at their tax rate, which was 30, we said 40% here just to kind of round up, that's $110,000 back in their pocket. So they had a total of almost $400,000 of real tax savings by utilizing this tool to be able to transfer their wealth, sell it tax-free, get income for life, and be able to save $400,000.
Wow. That's amazing.
Yeah, so this is all beautiful, right? But like, let's look at it without a trust and just look quickly and see what that might look like. Oh, I have a couple more click-throughs. So that $110,000 back in your pocket, you can utilize that to offset the taxes that you're going to have for selling the other portion of the business. So now we'll go into the sale of the same business. We're going to take just $1 million though this time, so it's apples to apples comparison. And we have that same $1 million asset with no basis. We're going to go ahead and pay our taxes and pay $288,000 to the federal and state governments. That leaves us $712,000 in an investment portfolio. And with a charitable remainder trust, the donor can actually have power over how they can be the trustee, and they can choose how the assets are invested. So this could be the same identical investment portfolio that you had in the charitable remainder trust. However, the charitable remainder trust grows tax-free. So it's in a tax-free environment. So that's also another thing of that tax-free compounding is a very, like the people talk about in your IRAs, you can get tax-free compounding in the charitable trust as well too.
Yes.
Yeah, so we got this 712. We still want our income, so we'll take the same 6%. But now that's only $42,000 per year, which gives them 1.25 of lifetime income. The kids are going to get less because there was less here in the portfolio to actually grow. Charity gets nothing. There's no income tax deduction. So the IRA ends up being a big winner here.
So instead of saving 400,000, right? Is that what it was? Let me look. So
Yep,
instead
it was 398. Yep.
You're paying, 2.75 more plus, 288. Interesting.
Yes, definitely. So I like to show this comparison. So we have lifetime income without the trust on the left, trust on the right. So without us, we had 1.2 income. After we paid for life insurance, we had 1.7 million of income with the trust. The inheritance went up because of the insurance proceeds. The charity got a lot more. And then I took a look at that income tax savings of $110,000 that we showed with a $75,000 deduction. If you grow that at 7% for over 30 years, it's over $800,000. So you're really looking at the net benefit of utilizing a charitable remainder trust in this scenario of $2 million. So a significant amount. That's why both Michael and I have been able to talk to people about about remainder trusts, whether they were initially charitably inclined or not. And I am going to exit my mode because I don't get to see your smiling face, Michael, when I'm in that mode. But I just knew I had too many boxes to click through to go through anything else. Anything else that you wanted to talk about a charitable remainder trust? Oh. Michael is frozen for me, so I'm hoping that you can still hear me. And that I didn't mess anything up switching of screens. But a lot of different assets can be used in a charitable remainder trust. So it really provides a great planning tool here. It can be rental property, commercial property, raw land. you name it. We do want to have something that that hopefully does not have a mortgage on it, but if there is some money owed on it, there is the opportunity to be able to do some planning around that too. All right. So I'm going to go ahead and move on to a hybrid sale or bargain sale that can also be utilized. So these have been in the tax code since 1917. We're not doing anything fancy here. We're just looking at win-win opportunities to help people save on taxes. So with this bargain sale, we take a real estate that has $1 million of fair market value, and the charity buys the real estate for $600,000, and because they want to make a $400,000 contribution. This does better when I have my click-through slides. So the charity gets a $400,000 gift. So they're taking their $1 million of real estate, they're gifting 400,000 of it, and the charity's giving them $600,000. The nice thing is with this is we can utilize, hi Michael, we can utilize other third-party organizations to help us with this transaction, because some charities have a little bit of a difficult time coming up with that $600,000. So a bargain sale can be a really neat way to be able to go through and sell part of an asset, utilize deduction, and but getting some of the income out of it. Real estate can be harder to separate than like a trust, but we could also do that with LLCs and do it in other ways too. But a bargain sale can be a real neat opportunity. So
sorry about that connection issue.
No worries. I'm just glad that I wasn't.
Our internet service provider is working on stuff out here, and so our internet keeps going in and out. But anyways, keep going.
When you need it the most, right?
Exactly.
Yeah. Additional proposals. Just know that if you make over $400,000, you're likely going to have higher taxes in a lot of different ways. They're looking at increasing the Social Security payroll tax to 12.4% for those making over $400,000, meaning both you and your employer, or if you're self-employed, you are going to have to pay 6.2% for both employer and employee. If you're if you are your employer, like myself, I might have to pay the 12.4%. They're talking about bringing back PEAS limitations, and they're looking to phase out the qualified business income deduction for businesses over $400,000. So just be on the lookout for some of that, and there's plenty of opportunities that we had already discussed in our presentation. There's other additional issues that people might have to face from this proposal, but since it is just in proposal form at this point in time, we're not going to go into too much detail on that. We know your attention span's probably already waning, but so here's a website for the full proposal here, and at the end of the deck is also is more information. So some of the key takeaways is whether where you're politically inclined or what you think might change in 4 years or 2 years. With COVID stimulus and COVID relief, taxes are going to change. Something's got to change. So just make sure that you're doing the proper planning and talking to your professional advisors about what your intentions are and what it is that you want to accomplish. And if you're looking to sell anything at any time soon, look at doing it more, look at 2021 for your larger assets, because it might be very tax advantaged to accomplish sales in this year. I do have a little cheat sheet I'm happy to give you. If you send me an email, go to my website, send me an email. This walks through all of the different strategies that you can use to be able to accomplish some gift planning solutions. I also have a different one for exiting a business and what some of those solutions are that you can use depending on your situation. So happy to always provide that. Is there anything else, Michael, that you wanted me to cover from my more lengthy presentation today?
No, I think you've done an excellent job in explaining things. I think some of these tools are really great. They can sometimes be a little complicated even when we try to, water them down and explain what they really do. So definitely getting in front of a professional like you, estate planning attorneys, things like that, to talk over particular situations so that you can see how they work for you is absolutely important. Even if you're under those limits, $1 million, $2 million, or whatever, with inflation and all that kind of stuff, and even your housing market is increasing like crazy, especially here in Arizona. You'd be surprised how fast you can reach those limits. So even if you're not making liquid cash every single time, or for $1 million or whatever, your total assets and the size of your estate definitely changes pretty easily.
Yeah, definitely. And it's great to have good planning and conversations with your estate planning attorney, your financial advisor, and your CPA. And then my work is really coming in and being a liaison with all of the different parties involved to be able to help the client or donor to get what they really want out of it, and see all of the opportunities, not just what the attorney might know well or the CPA might know well, but we can look at all strategies to see what would be the best fit, and then work as a team to help that client donor accomplish what they want.
Yeah, absolutely. So definitely check out giftplanninginstitute.com. That's what we have here on the bottom. To get your guys' copy of that, contact Tiffany for that as well. A lot of these CPAs and estate planning attorneys, they're not always experts. And so definitely having someone like you in their corner definitely will help them with that as well. So very good.
And I enjoy working with clients, donors, but also their advisors, or just advisors. If advisors want to learn some of these strategies or have a client-specific situation, I'm happy to help.
Absolutely. All right. Well, Tiffany, thank you so much for joining us today. And we'll go ahead and close out for now. But if you guys have any questions, definitely contact me or contact Tiffany as well at giftplanninginstitute.com. And then also I'm with legacyglobal.org. So you guys all have a great day. All right. Thanks, Tiffany.
Thank you, Michael.
Go ahead and see if this works here on my mobile phone.